Why isn't your stock portfolio up 100% this year like Nvidia is? Let's look at some of the reasons. Well, sensibly, you might not have put all your money in one company, such as Nvidia. Well, that's one obvious reason. The other reason is that you might not be looking at the right sectors, technology, semiconductors, graphics cards, all that kind of stuff, or the right geography. One of the complaints that a UK fund manager, Nick Train, has put in the Financial Times today is that, oh, I missed the technology boat because I only look at UK companies and we haven't got any. So, sorry, I've failed. Which is a pretty legitimate excuse for a fund manager because their hands are tied. Yours aren't, of course. What are the other reasons? Well, in my case, when we got in January 2023, it had become such a large part of the portfolio that I exited in April of this year because it had just become oversized for me. Now, should I have held some back? Probably, but given the other positions I had in that same sector, it was starting to get a little bit dicey. I don't tend to look at sectors, but given how much even a tiny movement was making, so you might sensibly already have had your gains. That's another reason why this year you haven't, because you had your gains already and you decided to ease back. But let's say none of those reasons apply. Oh, by the way, the other reason is, of course, not the opposite of not having all your money in one company is you sensibly had a portfolio of, say, 15 other companies in your portfolio and not concentrate too much. So what happens if now you look at the FOMO, the have I missed the boat syndrome, and how do you get around it? And what I'm about to say to you is a bit like, you know, when hotels put those signs saying no smoking, and yet you find an ashtray and you think, you don't want me to smoke, but you put an ashtray. That's because they know even if you are going to break the rules, I'd rather you did it safely. So I'm going to tell you something which I don't think you should do, but were you to do it, then at least I'd rather you did it safely than went off and burnt the house down or burnt the hotel down. So how might you deal with a FOMO company, a company like an Nvidia, where you feel you have to be in? Well, there's several strategies which can mitigate the risk of having missed the boat but still getting into the boat. So hopefully not drowning midway. Probably not a good analogy given we're at a general election in the UK and a lot of it's about boats. But anyway, so one way to do it is to have a smaller position than you normally would. If normally you put 5% of your portfolio into a stock, you might just put 2.5% or 1% in which case the problem is, well, wait a minute, I'm buying this for gain, so why the hell would I put so little money in? I'll give you the pros and cons of everything. The other way is to put a normal size position in, but have a stop where you exit if it drops 15% from the high since you've bought it. And the reason for that, your reasoning would be, well, if I've missed the boat and it's going to pull back, I don't want to wait for it to pull back 25, 30, 40%. If I think pullbacks are dangerous and likely, I'd rather have a tighter one on the basis that I'm only buying this because I think there's going to be far greater upside than downside. Well, if that's your logic, then presumably you don't think the downside's that great. Or if it is great, you want a tight stop loss on either. So you just say if it drops 15% from the high. That would be the logical thing to do on the missing boat scenario with those kinds of companies. And I guess that's one. I guess Eli Lilly's another. Now, I tend not to do that. And the reason for that is I like things simple. I like one strategy and that's it right across the board, which is my value growth income, rising momentum, that strategy. So should I have missed the boat like I have on, let's see, Eli Lilly? So be it. I missed the boat on that one. It would have been great to have had it in the portfolio. It would have been great to have the kind of gains that I was looking for. But anyway, it's the ashtray I'm giving you. If you're going to do something, then maybe that's one way to do it. Of course, going back to first principles, you want to make sure you don't miss those again by making sure you're not focused on one geography or just one fund manager, etc., and that you've got the ability to pick these in future and you've not just blocked yourself off from such good growth companies. Okay, hopefully that helps. Please do look at the links in the bio as well. Thank you very much.